we're now moving into the more economic impactful layoffs. You go back to the tech ones and early part of second half of last year, it was people with misaligned goals that didn't really want to be there. So they trimmed a lot of fat. I don't think if the unemployment rate needs to jump up to 6%. We'll probably see this thing move closer to 5%. I've been looking at that potentially as early as March data, but April, May, I think we'll start seeing the unemployment rate rise.
Bill Baruch, president of Blue Line Futures, joins us today to give us a trader's perspective on what's driving the markets today and what could drive the markets this week and beyond. Bill, welcome to my new show. Thanks for being here today.
Yeah, thank you for having me on. It's a pleasure to join you.
I want to talk about what's moving the markets today and this week, and also how you managed to get 42% returns on one of your funds last year. Exciting stuff. You have a new fund that we'll talk about. But first, let's talk about oil. So news coming out of today on Monday, crude oil spiked. It's brought fears to the tech sector in particular of companies that are concerned about this bringing up their costs. What's been driving up the oil markets today?
We had the news that OPEC Plus is cutting their production. From a headline standpoint, it's about 1 million or 1.1 million barrels per day that you're gonna lose. Overall, you can look at as much as 1.6 million. You've added in some of the Russian planned cuts already they're already really baked into the market. From a broad perspective, there's going to be 1.6 million barrels less of oil in the world that beginning next month. However, about only 700,000 of it is actually sort of new news. But of course, this is really lit little rocket under crude here to start the week. It's it's up about $5, trading above $80 in crude WTI contracts for May. We've had a pretty big move last week prior to this announcement. Maybe some people, kind of knew this was coming down the pipeline. But if you look back a month ago, the United Arab Emirates, they were actually sort of trying to get more production online and capitalize at these higher prices. But in that month of unfolding, we've seen some of the banking issues. We've seen some, the economies around the world point to slowing. So I definitely think what we're seeing here is OPEC Plus getting ahead of what could be, a market fallout. When we break below 70, I've always said it, market oil is in a bull market above 70 and it's a bear market below 50, and between 50 and 70, you can have some vicious volatility. And they're definitely defending $70. This is a statement, and they want to keep oil elevated. And this could be the start of a new bull leg. It's definitely increased speculation. It's going to increase speculation as open interest has been dwindling in the past 6 months.
Is that going to put a dampening on earnings, do you think?
Well, I think, first off, you see a huge move across the energy space. Stocks like Schlumberger, SLB, up 9% on the day, at least early on. Pioneer up over about 5.5–6%. Chevron up 5%. So there's some really big moves in the energy space. But this also, the crosswind here is what does it do to inflation? It's going to reinvigorate what was a taming inflation environment. And that's going to leave some question marks. What are we going to hear from Fed policy members in the coming days? We have a lot of data this week in general. I'm not jumping into conclusions yet. Crude spent much of the fourth quarter just kind of hanging between $77 and $82, and we haven't gotten out above 82, 83. That's been the big level. That's actually the failure to get above 82 to 83 turned me somewhat negative on crude oil towards the end of last year, and we reduced it in our securities portfolios, significantly reduced our energy exposure from vastly overweight to just a little bit overweight because of that. But we got the washout, and here's some news, and we'll kind of have to see how it plays out in the coming weeks and days.
It's interesting because the NASDAQ has had its best quarter since 2020, which is a big statement in itself. People are talking about the Fed being done, rate hikes, which could potentially, if true, provide another boost to the stock markets. But now we're getting this energy shock, which, on the other hand, could also put higher pressures on inflation, which, like I mentioned before, could possibly weigh down on earnings if companies' operating costs go up. So we've got a lot of competing macro forces here now, Bill. How do you see all this playing out?
Yeah, to start the week, NASDAQ ripped higher, sort of that melt up, something I was writing about much of last week, looking for some window dressing. A lot of portfolio managers and funds were just very offsides on tech in general, and especially the big tech, because remember coming into the year, it was going to be a value stock market and kind of throw the growth names out. That's not how we approached it, though. We've been very overweight tech. In fact, in our equity bucket, nearly 50% weighting in tech with lean on semiconductors. And you got this sort of that window dressing really right into the bell on Friday in the quarter end. Because those managers want to make sure it shows in those quarterly reports that they own the names that perform the best. And so I think naturally, I'm not surprised to see the NASDAQ and some of these tech names come in a little bit to start the quarter. However, obviously it's the headwind now is rising energy prices. What is that going to do to inflation? What is that going to do to the path of Fed policy? And we're already seeing, I think it was about finishing out last week, I think it was a 48% probability the Fed hikes 25 basis points. Now we've seen that today move up to a 58% probability they hike 25 basis points at their May 3rd meeting. So as you see Fed policy digest higher energy prices, again, extrapolating a little bit more inflation, it could weigh on tech. And we're seeing that at least start the week here right now.
We're heading into a year where a lot of economists are predicting a recession. And first of all, is that in the cards? And then we can talk about recession investing.
I, for one, have not been negative on the economy like others in say the last 6 to 9 months when this recession talk really took fold. You can't ignore the issue across the banking space right now and how it's going to tighten credit conditions, lending conditions. These regional banks, they're going to be under the microscope a bit, and they're the ones that are doing all the lending, especially to small and medium-sized businesses. It's going to slow growth. But at the same time, from the stock market perspective, I look at the equity market broadly as a leading indicator. And one of our themes has been the haves and the have-nots. What companies use 2022 and have drawn down their earnings expectations, and what companies have not. Micron may not be the greatest example given some of the China news that we've seen. They're looking into the cybersecurity issues with Micron, and it's been down about 5% since Friday. But Micron is actually a great example for the haves and have-nots. I mean, they really got ahead of that, and the semiconductor space broadly got ahead of that at the back half of last year. And they're the first ones that to the way down, and they're the first ones out of it. So it becomes a stock picking market, and I think overall, as those earnings expectations were taken down, that just really highlights how the stock market is a leading indicator. So I'm not negative on the stock market, but you can't ignore some of the tighter conditions that are going to take place, going to slow the economy. Still, I think the Atlanta Fed GDP now for quarter one is still at about 3.2%. It's just, there's a lot of question marks moving forward, but if the economy is slowing, we got ISM manufacturing data today, eroded more than expected. And it's going to push, keep the Fed from having to raise rates, but it really highlights, the path of inflation, which we were getting some light at the end of the tunnel before this energy news.
Just circling back on the economy real quick, recent layoff news, any of this surprising or concerning for you? We've seen layoffs in the tech space, but now I'm seeing Reuters reporting on Sunday, McDonald's is preparing to lay off workers across the U.S. As part of a broader company restructuring, the report says. People are preparing for sort of a downturn, or is this just cutting the slack and trimming the fat?
I think a lot of the tech layoffs that you go back to the middle of last year, we're now moving into the more economic impactful layoffs. You go back to the tech ones in early part of second half of last year, it was people with misaligned goals that didn't really want to be there. So they trimmed a lot of fat. And on top of that, I think there was, I forget the numbers now, but it was something like, 3% of the workforce, 3% of a lot of these tech companies they're getting laid off every year. And because of the pandemic, there was 0 layoffs in 21 and in 22 really early on. So they're sort of just catching up a little bit. I think it's a normal sort of economic cycle in these layoffs. But again, the Fed's trying to slow the economy. And so these layoffs are really going to, they're as the economy slows, they're starting to pick up a little bit. And McDonald's was more telegraphed in recent weeks, months, so it wasn't necessarily new news. But yeah, I think I don't think the unemployment rate needs to jump up to 6%. We'll probably see this thing move closer to 5% at some point. And yes, that's going to slow the economy. Now, the reason somebody say, well, okay, a lot of these layoffs were announced 9 months ago. Why aren't we seeing that trickle into the job market and the jobs data? There's a lot of severance packages out there, and the people sort of just kind of, enjoying their time at the moment. So I think we'll start seeing that in the data. I've been looking at that potentially as early as March data, but April, May, I think we'll start seeing the unemployment rate rise. And I think that will be seen as sort of a dovish impact on the Fed policy as well. So that could really stoke stocks higher in the right environment.
The dollar has been declining ever since the beginning of March. Let's talk about the dollar. Let's review what happened in March first before we talk about the future. What's been causing this downturn?
Well, remember the dollar was ascended for I forget exactly when to top, but because the Fed was the only one tightening policy, they were leading that move, and they were tightening at a faster pace than everybody else. And then we've seen Europe jump on the bandwagon. They hiked 50 basis points recently. They're the ones that are more holding that harder line, a little more tougher in the verbiage right now as they're tightening. So it has unwound that dollar strength completely. But we've also seen some strength in other currencies like the Aussie dollar here today as oil moves higher, and the metals have been performing pretty good. So some of the commodity currencies are seeing some life. But yeah, I think that it's overall it's you look at a basket of currencies like the dollar index, it's what's driving that basket, and 57% of it's the euro. So right now, the euro is actually holding pretty well, given how there's a lot of bullish sentiment around the euro right now. It's actually record long positions from speculators, leveraged funds in the euro. So it's, even though I think that we could continue to see the dollar broadly move lower over the next 6 to 9 months, it's a very crowded trade. So I'm watching it very closely, but it's just a matter of really these divergences in policy are going to drive the currency and drive the rate markets.
Yeah. So do you think that this differential between policy is going to continue throughout the year? At what point do you think central banks around the world, the ECB, for example, Bank of Japan, are going to start restricting their policy?
I think, the euros, the ECB is moving into pretty restrictive policy right now. It looks like they're going to try to hold pat for another couple of hikes. So yeah, I would see the reason to continue to believe the euro could strengthen. I also believe over a longer period of time, not necessarily something that's tradable right now, we're going to continue to see the depreciation of the U.S. dollar. There's a lot of components to how that could happen, but I think right now we're more likely to see or higher probability of seeing the Fed pivot to become more dovish and potentially cut rates than we are likely to see the ECB pivot from their current path, and that leads me to believe that the dollar could continue to trade lower relative to other currencies in the near term.
Okay, so how does that impact something like gold? So let's talk about gold. Been on a tear since in the last month. I can't help but notice that perfect inverse correlation existed between gold and the dollar, especially in the last month. Traditionally, they've been inversely correlated, so that's not really a surprising factor for me. But we've broken above $2,000 very briefly. It looks like we're heading towards that region again today on Monday. So how much of the strength of gold was due to the dollar weakness over the last month?
I think it's quite a bit of the strength is correlated to the dollar weakness. It's also correlated to rates coming down pretty sharply. We've seen, the 2-year yield got above 5%. We've seen that, back down to 4%, and kind of sort of trying to trickle up again a bit from there. But lower rates are supportive to the precious metal space as well as the weaker dollar. So I think it's a combination, but it's all extrapolating and discounting a potential rate cut by the Fed later this year. I think about 50 basis points of cuts are being priced in with a pretty decent probability, better than 50% probability right now. So I think It's definitely going to be something underpinning gold. I mean, of course, too, the narrative of why the Fed is pivoting, which is the banking sector, and some of the concerns there is creating a safe haven bid as well. So a lot of these tailwinds from the currency side, from the rate side, the broad safe haven narrative, they're all working together as really one theme, and it's helping underpin gold. I mean, gold is, you back at the chart out. It's easy to get stuck in the forest and miss the trees, in something like last year. But you back the chart out, going back a decade, going back 15 years, it's been an extremely very, very constructive chart, very healthy, and it looks to be building for higher prices. I'm pretty upbeat about it. In fact, we just launched a gold fund called the Metals Alpha. It's sort of just focused on things like precious metals as well as industrial metals. And I think overall we're in this sort of commodity super cycle. We're going to see metals broadly be trading higher in the years to come.
I'm curious as to how one of your funds outperformed the markets tremendously last year by a significant magnitude. I believe your return was 42%. You told me offline. Tell us about your strategy there.
Yeah, it's a commodity fund. It's a commodity trading advisor, and 40% of that is metals trading. So in fact, we actually are peeling that out, and it's going to be the base of this new metals fund as well. 30% of it is equity indices, so trying to catch trends there. Only about 15% is exposure that, trading, and these are rough numbers, energy. So we definitely caught some of the energy move in the first half of last year, and we didn't remain bullish in the second half of last year when it was sort of dwindling lower. So catching the right type of moves, and staying on top of policy and letting some of these moves play out, come to fruition. It's definitely been very helpful for us. Being patient, sizing. We like to think of sizing as our superpower in the markets, and just kind of stay on top of the evolving news.
Perfect. And what do you think are your top commodities and/or stock plays for the remainder of the year?
We finished the quarter extremely bullish on tech. Now, so this is separate from that CTA. Though we'll play the E-mini Nasdaq or Nasdaq exposure in the CTA or E-mini S&P exposure. We also run wealth portfolios through Blue Line Capital, our registered investment advisor. And within the equity bucket, for much of last quarter, we were nearly 50% weighted in tech. We had taken down our energy exposure at the turn of the year, and again, something I pointed to that we weren't really upbeat on energy. But in the recent weeks, we've added names like Schlumberger, got back into Pioneer Natural Resources. So we've been improving our energy exposure back into. I think we're up to 15% weighted energy again. We haven't trimmed the tech yet. We still, I remain bullish on it, but I'm not ignoring the environment that we could potentially see if energy continues to head higher. I think it's going to be an interesting one. I still leaning on that. Bring out your 2019 playbook, where the Nasdaq was up 40% in 2019. So that's something. It's kind of staying an ever evolving narrative, but I do like energy, and ironically I like tech right now. But I think in this environment, the only real piece of advice I give people is strong opinions held weakly. You're quick to change your mind as this market evolves, manage your risk, and know what your expectations are.
I want to close on this thought. I know you're not bearish per se on the economy, but just suppose, hypothetically, we do enter a recession. Historically, what are some recession-proof plays, both perhaps in the stock markets and also in the commodity space?
Well, outside of our, so we have a wholly diversified portfolio on the security side for this wealth for these wealth portfolios, and so. About 50% of the whole portfolio is equities, and 50% of that is tech roughly right now. But as the portfolio as a whole, we actually in aggressive portfolios have 6.5% weighting to gold, silver, and gold miners, and I think that's something that really becomes a ballast in times of recessionary fears. Sometimes the miners have always sort of underperformed, but they're at such a level that there's really tremendous upside, and especially if gold continues to improve in price due to recessionary conditions. I think that's it's a great ballast to have, and have great exposure. The other thing too, I mean, listen, a lot of, I mean, if we're not in a deep recession, I do expect the fixed income to really perform too as another ballast to the portfolios. I mean, you look at some of these funds that are out there, mutual funds like a BlackRock fund or Double Line fund. I mean, some of this stuff is actually really, really terrific right now because there's value if yields don't continue to rise, which I think that's the environment we got to prepare for. So recessionary like conditions are going to see the short end, the 2-year can get below 4%. It should help underpin some of these funds that we use in our portfolios. So I think I'm pretty upbeat on what fixed income can bring as well right now. So it's just about really, really diversifying and being patient and kind of, like I said, we cover a number of things from our commodity funds to our securities portfolios, and just trying to stay on top of the ball with all this ever evolving world.
Perfect. Bill, appreciate your thoughts, and good luck on your fund. What is the name of the fund, just so we know?
Yeah, we have the Metals Alpha is what launched here today, and then these are both QEP funds, Metals Alpha, and as well as the Global Opportunistic is the main one that's more of a broad macro overview.
All right, well, cheers to another 42% this year, hopefully. Thanks for coming on my show, Bill. We'll speak again soon. Appreciate it.
Thank you. Bye.
And thanks for watching. Please don't forget to subscribe.